market correction typically makes some of the highly valued and fundamentally strong companies look very attractive. And one such company is Endurance Tech. Its stock price has fallen by more than 43% from 52-week high in November 21. The overall market correction, demand concerns in Europe, shortage of semiconductors which led to production cuts by OEMs proved to be a headwind for the business as well as the stock price. However, we believe the company is a global force in aluminium casting, suspension, transmissions and braking products, and we continue to remain upbeat on Endurance primarily on the back of its significant presence in the two-wheeler segment where EV adoption is gaining pace and has a strong order book. In Q3 FY22, Endurance's business was impacted by commodity-linked cost pressure and severe chip shortage. Though the company's top line remained flat on a quarter-on-quarter basis, its EBITDA margin got impacted by the rise in raw material prices and contracted by almost 300 basis points on a QoQ basis. Geographically, the India business outperformed European business as Europe faced massive shortage of semiconductors, leading to a decline in car production. India business revenue declined 2.6% YOY, while Europe business declined 22% year-on-year. EBITDA margin of India business contracted by 590 basis points YOY, and Europe business's margins contracted by a whopping 860 basis points. The contraction in Europe business margin was led by negative operating leverage and a significant rise in input prices. Endurance generates most of its India business revenue from two-wheeler segment and has a very strong position on the back of its technologically advanced product range. It's therefore the best proxy to play the growth in two-wheeler segment. It's also important to highlight that despite the 23% YOY decline in the two-wheeler industry, the company registered a meager revenue decline of 2.6% in the segment, driven by market share gains and new products. The management has highlighted that long-term outlook for the segment continues to be encouraging for the India business, as is evident from the order schedule. Europe business, however, continues to struggle due to the semiconductor shortage. Europe vehicle registrations were down 23% in Q3 FY22. We expect Endurance to outperform the industry by acquiring new clients and increasing its wallet share from the existing ones. For the India business, it has acquired new businesses worth 345 crores in Q3 FY22, which includes an EV order worth 139 crores from Ather and Polarity. The company continues to focus on higher value-added products, which include the likes of brake and clutch assembly for 200cc plus motorcycles, ABS, paper blaze clutches, inverted front forks, and fully machined and semi-finished casting. In fact, the company has already commenced the supplies for ABS and brakes for 200cc plus motorcycles from September 2021. The supply of clutch plates has also commenced. Despite the weakness in Europe market, the company received new business worth 43.6 million euros in Q3 FY22 from the likes of Daimler, CNH, BMW, Porsche and Stellantis. Such strong order wins give the company earnings visibility over the near to medium term. Management is focusing on cost efficiencies, higher value-added products and import substitution to improve its operating margins. Endurance has acquired two companies to get the required technology and capabilities to make new products. It has also carried out backward integration into aluminium forging, axle clamps for front fork and wire-grade hoses for ABS brakes, which will aid improving operating margins. Endurance is now trading at 21.7 times FY23 projected earnings, which is at a 32% discount to its 5-year average value of 32.1. Now, we believe the current valuation is reasonable given the company's stellar financial track record. We advise investors to accumulate the stock in a staggered manner. Any slowdown in demand, of course, could hurt financials, so an important risk to watch out for will also be adverse commodity prices that could increase raw material costs and impact operating profitability.